All right, welcome to the Super Team Podcast. We are recording after very long. We were traveling for a bit, and then the conference happened. Akshay, how's it going?
Very good actually for the condition in the markets. Like if you look at Twitter, it feels like
Yeah,
we're going
it's
back to
not.
web -2, but I feel pretty good.
It's not your first bear market. No, that's why you are fine.
I mean, it is mine. I've just seen it as a spectator last time, much like many folks here is experiencing a drawdown is pretty painful. So
Who's our guest today, Akshay? Can you introduce us to Mr. Joel John?
yes, so welcome, Joel. Joel is a principal at LedgerPrime, which is a venture fund and also, I think, a hedge fund. Joel, correct me. But he's focused on the venture investments for LedgerPrime. He was one of the earliest, Bitcoiners in India, going back to I think 2012, 2013, and we're very excited to talk to him about all that he's seen in India. He's recently moved to Dubai, but continues to be very actively involved in the early stage venture industry in India. Welcome, Joel.
Hey, hi. Thanks for having me on.
Joel, why Dubai?
The weather is great. Lots of
Really?
sunlight. Yeah, that's
Did
it.
you hear me wrong? I didn't say Bangalore. I said Dubai.
No,
Why
the
Dubai?
weather is just awesome. I think jokes aside, it's look. I tried moving to Singapore in 2019. If you're trying to move out of the Indian ecosystem, I feel like Dubai is the most welcoming place right now. The second thing is the financial market here is evolving quite rapidly, so it felt like the right place to be at. And the third is I feel like this region is soon going to be a hotspot for startups and all forms of innovation, not just crypto. Obviously, there's a certain angle of the regulatory landscape in India being the way it is, but these are the other reasons why I would be here.
All right, Joel, did Akshay get the introduction right? Is there something that he missed? Is there something that you would like people to know
Yeah,
about
yeah.
what you do?
So I think LedgerPrime is not a venture fund. I think it's that's on us because we don't market ourselves much. We are basically a market maker, a hedge fund, and then a venture fund. I think I can break down what three of them do separately at a later point. But venture is not the only thing we do. That's the one thing.
Okay, and how is everyone feeling about this winter? Has it come? Is it here?
Yeah, so I think I can give you some context because you guys were discussing bear markets earlier, right? I feel like this is the fastest that I've seen a drawdown or change in sentiment within a 30-day period in like 5 6 years of being in crypto, right? So the difference between 2018 bear market and the current bear market is that the change in sentiment has been really rapid. When Mt. Gox went down, you had like some 3 months of realizing that hey, this exchange is down because everybody was waiting to see if there's going to be a fix. Whereas with Celsius and what's happened with Three Arrows, the news came out overnight. So people have had less time to really just deal with that news, right? It's the same thing with Terra and UST and all of that. So is the winter here yet? I would say no, which sounds bearish, but I feel like startups have not really felt the pinch yet. It's mostly liquid market money managers that have felt the pinch. It's individual investors that feel the pinch right now. Startups will feel the pinch maybe 2 3 months out, right? Like that's when we'll see more layoffs, startups shutting down. That's when you see winter.
Wow, so the winter's not here yet.
No, no.
This Why is it so cold then? It feels pretty cold, Joel.
This is just a blizzard. I feel like this time things are amplified a little more because retail participants are more proactively involved in crypto. So they're talking about this on Instagram. Like last time, nobody was talking about this on Instagram.
Oh
NFT,
yeah. I see all my Instagram mentions with people getting pissed off, saying nahi dekhna chahiye tha video.
this time, right? Like I would say, I think NFTs weren't there around the last time, right? Like nobody was buying monkey faces for $500,000. Like, that just happened this last 6 months. So the third is brands that raise billions of dollars have spent hundreds of millions on retail education, which is now coming back to bite them, right? So let's say you bought stadium naming rights for $500,000 and now everybody knows you and people have lost money, then I don't know how you justify that investment, but that's the other thing.
Not only have they lost money, they've lost money using you, and now they have to see you when they go out to have a good time. Like, why are you doing this?
Yes, yes.
Joel, do you have any advice? Say founders. You're saying that startups will start seeing the pinch in the next few months. So, what advice do you have for founders?
So I've often thought why are people in finance so philosophical? And what I've realized is that it's because they see a lot of the people that they work with just die out of the industry over time. One of the things I was thinking today morning is that the bear market is basically very similar to what you have in nature in the form of winter. Like we keep using that analogy. The only thing that matters during a bear market is survival. If you can survive, you have a larger portion of the market share, which basically makes sure that you have a dominant position in the next cycle, right? What every founder, manager, employee, everybody should be thinking of is how do I survive long enough in this industry that I can actually capture enough of a market share to make wealth in the next cycle. That's the only thing that matters. It does not matter if you have the hottest innovation. It does not matter if you have the best branding. If it's not feeding to the idea of survival for the next 2 years, right? Like that's how I put it.
What's like a couple of good examples of people who didn't survive, and not someone like folks who got blown out, but mostly folks who maybe lost interest or like for reasons that were in their own control. Well, I guess you could argue leverage is in your control,
Yeah,
but you know what I
yeah.
mean.
So I think what often happens is not that the founder makes the decision. What happens is you have pressure from multiple stakeholders, which leads to a founder making a decision. This is a very touchy example because this is a very good friend of mine who would have very likely built a multi-$100 million company in the analysis space, right? So last bear market, March 2020, there was this firm called Token Analyst. They were really one of the best analytical tools for hedge funds and financial, market participants. But then March 2020 happened, and I would presume it's got something to do with their board or them having a lack of runway. But they were a really good company that shut down. And what happened is in May 2020, I believe, is when Nansen really started taking off because there was that market gap. And now Nansen is valued at $750 million, right? So in hindsight, when I look at it, that firm was not doing anything wrong. They had brilliant customer support. The tech stack was awesome. Some of the smartest founders I know. But obviously, in the thick of April 2020, nobody's thinking, hey, crypto is going to be relevant anytime soon, right? Because you just saw Bitcoin go from 10,000 to 3,500. Most of your paying customers have likely vanished or gotten liquidated. And you're thinking, hey, maybe it's time to shut shop. So, what usually a lot of founders need to do is communicate with their stakeholders about where they really are at, because that's the other thing that happens in a bear market is people give false ideas of where the firm is at, and then they run out of runway, and then they just push employees and other stakeholders off the edge. If you're as honest about how messed up things are at right from day one, you can either get people to be working twice thrice as hard for survival, or you can be very clear about this is what's going to happen, because a lot of bad blood comes when you say, hey, everything is fine, and then 2 months later you're like, hey, unfortunately we had to shut the shop down.
And can you maybe talk about resetting expectations? What are the like, folks are flinging 50 ETH at like these NFT projects, and then flipping that into 75 or 100 ETH, and now like projects that are like really core infrastructure stuff are struggling to somewhat maintain market cap. I think Instadap is way below where they probably should be given the sophistication of the product. Like how do you square those with the expectations people should have?
So I think, without giving you names, because I think this is homework people should do on their own, there are firms that have more cash in hand than their market cap right now, right? So let's say their treasury is worth 100 million, but the firm is valued at 30 million. The token and the network or the firm's valuation has a mismatch. And I think in InstaDapp, because I know the founders, I would say, hey, that's very likely the case. You cannot take token prices as a measure of where a firm is at, especially in a bear market. Actually, you can also say that for bull market, because in a bear market you have a discount, in a bull market you have a premium, right? Finding the equilibrium is what most of the work in finance really is.
Do you really think the treasury value reflects the value of the thing? Because these are just governance tokens. These folks who hold the
Some of
tokens and
these
know.
some of these guys were invoicing in dollars, so they're literally sitting on USDC. But you can always say,
I understand.
yeah.
No, I'm saying assume that the treasury is in USDC. Do the token holders really have any?
No, they don't. They don't. Unless you're talking size, right? Like I'll be very honest with you. If I go out and I buy 0.001% of Uniswap, I don't think I can afford that. Let's say one by hundredth of a percentage. I mean, that's still a large number. Let's say a very small chunk of Uniswap tokens. I cannot go out and say, hey, Hayden should be doing X, Y, Z. I need to have meaningful enough ownership. Even then, I may not be able to exert enough pressure on the founding teams, right? So, no, that's not
Or even for that matter on the treasury,
on the
because
treasury.
if
No.
they were to distribute that, or you're not entitled to the treasury, and often teams vote for the treasury to be spent in ways that the token holders may not be okay with, but they still do it, and then that discount is doesn't play out as
It
One would
doesn't.
hope.
It doesn't. So a lot of these discounts is basically the market saying management is run by idiots, and this is the discount we want to be involved with there, right? Like there is that angle too. Yeah.
Okay, so folks should be looking at like I guess the quality of governance and things like this
For,
while
for
making this.
sure. I think what I look for in a bear market is, can I really tolerate this team and this founder when things are really, really bad, right? Now that makes me sound like I'm marrying a founder, but I'm not. But firms are, fundamentally places of chaos, especially in a bear market. And if you cannot respect and also like find ways to work together during the bear market, then you're better off not investing in it. So that's the way I think about it as an investor. Now, as a passive investor, I would say you should always judge the team by how it communicates publicly. I would say, because if you're bad at communicating in a bear market, you're dead. There is no two ways around it. I know enough teams that's run by 5, 10 PhDs and 3, 4 Stanford, Oxford, what have you, right? They all die in the bear market because they don't know how to sell. Second, I would say is think about how are they really trying to empathize with the customer, because if they cannot find a potential customer or a developer, they die. And the third is obviously how is actual on-chain stuff looking, right? Like if a bunch of VCs are getting tokens and they're constantly selling, then that's a bad signal. You should likely just sell it off and call it a day, really.
And any advice for fellow investors of how do they find the best projects during the bear market?
What I have seen, at least through the last cycle, is that you don't really find the best project, you find the best founder, because you basically find a person that is so madly passionate about something that you don't want to bet against him at all. So that was my experience with Nansen, because the founder was so passionate about it. I would rather not work with anybody else, but find a way to work with him, because he's the guy I think that knows the most about data markets. Unless you have very niche knowledge about a certain topic, for instance, in DeFi or gaming or NFTs, what you ideally want to find are the people that are the most passionate about something, and then they go out and find out how to dominate that niche. Now, what happens when you go sectorially is that, let's say, I think metaverse as a theme or gaming as a theme is really going to take off. It could happen so that this industry goes 100x, but the particular investment that I did went down to zero. So this actually happened with Loom and Matic. So Loom was a similar scaling project back in 2018, 2019. A lot of investors invested in it, but Matic is the one that took off. So one way that some investors hedge against it is externally it looks like spray and pray, but internally the word is they're trying to index their bets, right? Like make a small check across all the players, and then you wait for the theme itself to take off, right? Like that's what
I
happens.
just want to double click on India for a second. What are the major differences you're seeing between 2018 batch and this batch?
I mean, there's more similarities than differences, to be very frank with you.
Sure, sure.
I would start with the similarities first, right? Like I think there is what is basically called beginner's luck in a bull market, right? Like when everybody's hyped and excited about the next thing, and you're starting off with something in Web3 this cycle, or ICOs the last cycle, the market has an appetite for what you're doing, and you think you've found BMF. But as the big waves of liquidity that comes in during a bull market vanishes, you basically find who is swimming naked, as in who doesn't have PMF. And that's happened out both in the last cycle and this cycle. The only difference is last cycle there were fewer people. This time there were more traditional investors and what have you going all in, right? Now, having that said, what I've seen this cycle is the talent base is way more sophisticated. So last time it was all like, yeah, $500 ICO में डालना है, कुछ पैसे बना लेंगे. This time it's like, hey, how do I learn how to code? How do I learn how to be a marketing manager for a community, right? So the younger folks, they're not looking to make a quick buck. They are seeing this as their career path. As someone who used to intern in crypto, like back in 2015, 2016, I was just mind blown. I'm like, this is the dream, dude. Like, folks want to work in Web3 full time. I'm getting goosebumps just saying that. And I think that's what makes me really bullish going to the next cycle, right? Like the speculation is on the lower end this time.
So there was an interview recently where I think Packy was asked for a use case for Web3 that was a clear and specific. He chose to talk about real estate, and they had a back and forth debate, and that created like a furor on Twitter. And with Packy having to clarify later that he may not have had the best day. And equally, as of yesterday, you saw Tyler Cohen ask Mark Andreessen what was the most interesting use case he thought, especially in media, and they had a back and forth. We'll link to both of those clips below. You generally felt like they were not able to make, despite being exceptionally good folks at communication, not able to make a case that the viewers thought was compelling enough. How did you think about that conversation? And if we were to ask you the same question, would you like to articulate something that you're like that you could be very specific about that makes the case for Web3?
Yeah, so I think on Paki's case, what happened, I believe, is he was sick, and then it's also hard coming up with an example right on the spot unless you know what the other person really thinks about Web3, right? I didn't really go through the other interview today morning. I didn't have chance, but I think I'll give you an example that I think is relevant. But before we do that, I think we should take a step back and think about what is Web3, right? Like Web3 is not just about using a wallet and a MetaMask. It's not just about the .eth names. It's really a whole infrastructure. So when we're talking about Web3, I would think that the change is not uh, just consumer facing. It's in the whole stack. So right from where is your media stored, how is it accessed, how is it IP'd or licensed to the person, and how are payments made for it changes. Tools like Filecoin, sorry, IPFS, and the like are basically changing how media is stored. But that's boring stuff. It doesn't matter if it's stored somewhere, right? But let's take a complex industry, like let's say the media industry, especially with music. The way artists are paid today, or the way the royalties are split, is actually quite opaque because nobody knows which of these streams are run by real people, where are these people coming from, what are the incentives to listen to a music, and if they want to stream money as a payment for that little piece of music, there is no way to do it. So if we had to think of a Web3 native Spotify, one thing I would say is, like, let's say it's Tanmay and Akshay release a track. Now what they could likely do is the first thing is they could directly raise money even before the track is released. So you could just issue NFTs to whoever gave you money to do that, and you can say that whoever holds this NFT gets a stream of the streaming royalty that comes. So that's the first thing, is the ownership. Now the second thing is you can also say, hey, how do I sell these tracks and associated goods to a market of 50,000 people across the world, where IP rights are different, payment processing is different, conceptions of how ownership rights are different. I think Web3 gives a meaningful way to standardize it, right? And that's what standards like ERC 1155, the NFT standard, or the payment standards that we use on Ethereum are doing. They basically bought very different payment standards to streamline function at a global scale. So first is you sell streaming rights. The second is you sell ownership rights. And the third is you could even charge, let's say somebody has 10 USDC in a wallet and you want to charge 1/100th of a cent for listening to your music once. That is something that the new age payment networks can do. Now you could always be like, hey, Stripe can do it. Yes, Stripe can do it. You can do this on AWS. You can have teams of lawyers dealing with IP rights globally. But the difference is anybody can come in and do this today, right? Like earlier, you need a large recording label to come in and help you with the lawyers, with the Stripe integrations, with all of that. In the context of data and financial markets, I think Web3 would take entirely different forms, and that's a much larger conversation. I think I would rather write that down than speak about it on a
That speak about it.
podcast.
Got it.
Yeah.
So I think it seems like you're saying that this is almost like a legal system on the internet, one that competes with, I guess, the meat space legal system. Is that a fair point, or do you think that at some point the meat space will recognize the digital?
So I think, look, this is the internet is basically a remix of the past. Basically, this is a book by Tim Wu called "Who Calls the Internet," and I recommend that book because you can go back
Who
to
owns the internet?
who
Right?
owns the internet. John Oliver talks about it in his last episode, by the way. But the reason why I recommend that book is because it's like going back to 2005 and getting an idea of what people were thinking about the internet in the 1990s, right? The same conversation, is the meat space going to recognize the digital was happening back then too? It's just that we were babies back then. We don't even know what conversations happened back then. But this is something that keeps happening cycle after cycle. Now, will the meat space recognize digital? I think it would when they have the right reasons to do it. So, for instance, when Napster came up in the late 90s, early 2000s, it was a problem for the record labels. But when Apple came up with iTunes, they had the distribution to force the record labels to come and acknowledge that, yeah, nobody's going to buy your CDs now. You have to stream digital. And that is when change happens. So change can either happen ground up, that's when a lot of people are using Napster, or a large enterprise comes in and says, hey, we'll give you the distribution and the legitimacy, and we'll force all these other smaller players to come in to this way of doing things, right? Like that's how it put. That happened with television too, by the way. Yeah.
So you said in one of your articles, which I find interesting because we are really interested in grants, and crypto's kind of found this new way of financing public goods or projects that may have runway for to raise venture capital, but it's too early, or maybe the founders are not like haven't proven themselves out, and so there are these things called grants, which are an equity-free payment made to teams that are typically made when they submit a proposal. You said the following about grants. Depending on the stage and nature of the application, there's some $12 billion that can be tapped into through different grants. Much of this capital is non dilutive and target based, so you get to build something of value without giving up large chunks of ownership. Do you want to
$12
maybe
billion
talk through,
dollars.
Yeah, yeah,
yeah,
yeah.
how you came to the number, and maybe why grants are uh, it sounds like they're less predatory than the alternative in maybe tech and web 2, so maybe if you can articulate why.
Sure. So I think first caveat is of that 12 billion, maybe it's likely 4 to 5 billion now because token prices are down, and that's me being optimistic. I'll have to check after this.
Soon to be 200 million.
Could be anything. But look, I came up with that number. I believe we studied the treasuries of a number of DAOs, and we kind of studied what percentage of it was allocated towards grants to try and get an estimate. I think deepdao.io has some of that stats. Thoughts on Web3? Sorry, on grants. I think is it non-predatory? I wouldn't say with a straight face that it isn't, because grants have very clear mandates on what you're allowed to do and what you're not allowed to do. And oftentimes, traditional forms of capital also comes with access to network and support that a grant may likely not have. But where is a grant most effective, right? Like, so I've been giving out some grants on behalf of certain protocols. And the idea is this: if there is a founder that's doing something cool and we want to validate it without necessarily going through paperwork or 6 months of time or talking to 50 investors, we just give them capital. It's like go do A B testing, see if this works, then we can do a larger round. If not, no problem. What happens is you burn money to save time and effort of that founder for the next 6, 8 months. It may sound ridiculous, but it's a lot better than raising a few $1 million and walking around 2 years without PMF, right? So to give you the ratio, I gave away like 3 grants in April, of which one has done a follow-on round, one has shut down, and one has pivoted. And it was just like $10,000 grants that we gave for that, right?
So just to be clear, anybody with an internet connection and a good idea for any protocol that has a treasury, which most do today, almost everyone has capital to deploy. Typically, is it like maybe 40-50%, something like this, of the entire treasury is dedicated to what we call community,
Yeah, so I
and
think
is it comes out of that?
yeah.
Yes.
So conservatively, you could say 30% is earmarked for grants, and then the rest is usually what's given as investments and the like, right? So for most of these protocols, if you just need one thing that has a PMF to justify giving that entire grant. So on Polygon, there was this one grant. I think it's mentioned in the article. If not, I'll find it. There was this one grant that yielded a result of a firm valued at $300 million coming out of it, and that was a grant worth some 20,000, 30,000, right? Uniswap, valued at $5-10 billion at peak, was initially a grant project. So basically, what you're doing is you're collapsing the cost of experimentation, which has beautiful outcomes for both art and especially entrepreneurship. Right? Like I see art as a form of entrepreneurship, so I don't want to separate it. But so somebody in Bangalore has unique insights on how is a small village somewhere in Karnataka thinking about credit. And if you're able to do an active research on it and say, hey, blockchains can help with ABC, I want $5,000 to go out and experiment. Can you do it? They would do it, because what they want is really not financial outcomes alone. They also want stories and narratives and experimentation, right? Like, how do you find the smart people that are willing to go out and do these crazy experiments that traditional academia or enterprises don't do today? And that's where protocols are willing to give away these grants. It's got a lot of financial thinking behind it. It's not like you're doing on-chain UBI, right? Like that's how I put it.
One interesting thing, Tanmay, I know we have spoken about this, although not on the podcast, but now might be finally the time to actually talk about this, is you can bootstrap an angel fund with your labor. And you would do it in the following way. You would pick the projects that you want to accumulate the tokens of because they're massively underpriced. None of this is financial advice, by the way. We never talk about tokens, their prices. We really don't care. So let's say you have zero capital, but you're talented and you're willing to put in the work. You pick the projects that you're most interested in, right? And you feel like the team is great and the idea is awesome, and the project is somewhat undervalued. You can actually apply for grants on their project page, and you can do this over the course of, maybe the grant is for a project that lasts for 4 weeks or 4 months or an entire year. But you can bootstrap an angel fund just with your labor by applying for grants, getting paid in the native tokens of these projects, and holding them. And you may apply for 3 or 4 or 5 grants, as long as like these projects are time bound. You can do them within 1 or 2 months, and then by the end of the bear market, or maybe in 2 years or whatever, you have a portfolio of 6 or 7 or 8 investments. Do you think that's a reasonable strategy,
It's
or do you
it's
think
it's
these
it's
grants have to be
100%.
longer term?
It's 100%. I think there's two ways that you can do it. One is, you find a protocol or a founder that you're absolutely gobsmacked by and you think he's doing something cool. If you can afford taking a slight paycheck cut, this is all the more relevant if you're in India because your cost of living is relatively lower. You basically get compensated in tokens, ride it out through bull market, right? What I would also say is, even if you're getting paid in top dollars these days, because token prices is so suppressed, you can just buy some of them in market, right? I think the way I used to think about this long back before when I was interning is, I always used to think, what would be the value of my per hour work if the token price goes up 10x hypothetically. And what happened, because I was so early back then, is the price did go 10x up, and that paid out well. Now, I would say there are some caveats here. One is, I hope to God people are reducing their cost of living, because this does require, taking a pay cut. It's not very glamorous. Second is, you have to be very, very careful about which teams you work with, because if the token is not going to be around in 6 months, you have a very real problem, right? Like, it's just like ESOPs in the Web2 world. And the third is, it's it's not like you should have a strategy that X% of my income going into tokens is fine. Don't go 100% into tokens, because nobody knows what the future is. There could be another pandemic. I hope to God there isn't. There could be other black swan events that we don't know about. So it's totally fine if you just sit it out in dollars, depending on where you're at in your life, right? I think that's one.
Yeah, I mean, even without the black swan events, it's down 50% on like a Thursday. Like,
It's
so
painful, right?
yeah.
Yeah. So, as if you're running an angel fund, the one thing I would say is, never be a forced seller. So what that means is, the kind of assets that you're buying, don't think, hey, I want to take it to this point, and then I just want to sell it because I made my money. Ideally, you're in assets that you can hold for as long as you want, because the moment you sell it, you have a problem of redeploying it, right? Now, obviously, in a bull market, I wouldn't give this advice, but in a bear market, you ideally invest in assets that you don't want to sell anytime soon, and you don't have to sell anytime soon. So, no leverage, hold dollars, no credit card debt. Uh, you know, keep it low
Do
key.
you believe in the Bitcoin or Ethereum as the currency for denomination, or you think that's just like that's a meme?
No, I think statistically, going back to the facts, if I had to bring out the numbers, I would you can say that BTC and ETH has this depreciated form, and then it rallies, and then all coins pick up steam, right? Like that pattern is very real. But I don't over-index on any one asset, and that's because I work in crypto. I work with a hedge fund in crypto, so I don't want more exposure in crypto, right? Like, I want a small house in Kerala by the beach, where at some point in time I'm not going to be caring about the money. I want to see a sunset, and I don't drink beer, but I'll drink coffee, right? Like, that's what I want to do, and that's just me. But there are people who do just BTC ETH too. Yeah.
Yeah, we may know some of them for the last week or so.
All right.
All right.
Joel, you wrote this. In my understanding, the African ecosystem is massively underinvested. Of the 50 to 60 billion dollars that has gone into crypto venture, only 170 million has been invested in Africa. That doesn't look right when you consider the number of people coming online and the fact that the region has one of the youngest populations in the world. Can you double click on this? What got you intrigued in Africa, and then what got you down that rabbit hole?
170 million has gone only to Web3 ventures, right? So 5 billion has actually gone, so of global venture capital money, about 5 to 6 billion has actually gone to startups in Africa. But when you take specifically the Web3 ecosystem of 50 to 60 billion, only 170 million has gone, right? So when you say, hey, a lot of people are coming online, yes, capital is going into the Web2 world. It's just not going into the Web3 world in Africa. Now, what got me interested in Africa? I think, look, I'm in Dubai. You take the map and you see Dubai is up here, and then there's this giant continent, right below, and I'm like, I have no clue what's really going on there. And that's really what happened to me. Is I had this epiphany that there is this giant continent. Nobody has any understanding of what's going on in Web3 there, and I was like, let's do some research. But the other reason was that when I started my blog, the whole idea was that I'm going to start sharing stories and narratives about underrepresented parts of the world, especially Southeast Asia, and Africa was part of it. So I've shared stories of the Southeast Asian founders, but in the Africa side, I was quite clueless. So the best way to really get in touch, usually when you want to understand the ecosystem, is you just publish your research on it, and that's really what happened there. And I ended up actually I have a call with all three of the largest exchanges in the region, like later this week. I also found investors that are interested in investing in that region, right? So you're right. A lot of people are coming online, young demographic, underinvested. So it has a lot of similarities to where India was at in 2012, 2013. The difference is India is a unified country, Africa is a continent, makes a lot of things different. But how investors think about these regions are very, very similar.
All right, Joel, you wrote about the future of NFTs, which I think is one of these things that's massively overrated and massively underrated. Maybe just for the context for the folks watching, I just want to quote the section that we thought was most interesting from your article on NFTs. We're going to link to all these articles. Going forward, brands will use NFTs as a way of sparking consumer segments that are power users. Running a health tech app, how about airdropping NFTs to the first 1,000 users with the most activity? How about consumption apps like Deliveroo or Grubhub? Use NFTs to encourage healthy behavior or signal the most active users of the product. Think of NFTs as a participation certificate that have now gone on chain. Why? Because it unlocks new customer perks. Historically, brands held all the data pertaining to a user, and an independent third party developer could not incentivize these users directly. Using NFTs enables that. There's a lot to unpack there, but you can start where you like.
Sure. So I think, man, that piece is like one of those, what's the point of Web3 pieces that I had to write? Because I wrote it out of a little bit of a crisis in the sense that I was trying to justify why does this really matter, right? But I think the first thing I would say about NFTs in the context of crypto is that it's the first time that art and financial markets came together in a global scale with a liquid asset that is ETH. And that's why you have things that are massively overpriced at like $500,000 that have now come down to $80,000, right? Like it wasn't about the art or any of it. It was just that it was an alternative financial market that existed. A lot of the newfound crypto wealthy had to signal. So they were like, I'm going to buy this thing regardless of what it costs because I want to show people that I'm rich.
It's a fun game of wealth distribution.
That's what it is, and I think it's a core part of human behavior. Like even when in the 1400s or 1500s, when wealth was being made in the banking dynasties of Europe, they were also buying art because somebody would come home and they would be like, hey, this piece was made by this guy, so you're likely rich and I could give you a $500 loan if I had to. Obviously the average man, the person that enjoys a 10 rupee Maggie is not going to be like, yeah, mujhe to ye $300 ka NFT khareedna hai, right? Like they're not going to be buying NFTs because it costs something. They're going to buy NFTs because it gives them something. And that's why I said it brands are going to be increasingly using these as a way of unlocking customer segments. The simplest example that I have for you is if you go to mirror.xyz, and if I post an article there, I can actually airdrop the ownership for that article to 100 people. And I'm actually going to be doing that very soon for some of my pieces. Is I just want people to be owners of my intellectual output. Why? Because tomorrow, if there is a coin that's coming up that wants to work with me, I'll be like, hey, these are the 100 people that helped me the most when I was writing stuff. Can you airdrop to them? And so what's basically happened is I've identified 100 people that are my core audience. And I said to this other network that you don't even need to know their names. Just go to a query, you can find those wallets and just send it to them. I'm never going to talk to these customers. I'm not going to be doing anything. The whole thing is on chain. And I think that is the beauty of it, is that it's anonymous, but hyper targeted, and it's also relevant to the audience, right? So That is an actual use case of Web3 for you, by the way. And that I think is how NFTs will work going forward, right? Like
Yes,
one
like a
way,
customizable, interoperable databases for everyone
without identification, by the way,
without identification.
without identification or communication. So let's say same examples that I used. Tomorrow, why not, if I'm running a health tech app and I'm able to target all the people that go to McDonald's, and say, hey, here's a token you can redeem for a new health tracker. That is when it becomes, hyper targeted and relevant. So you still have the advertisement models of Web2, but with a certain layer of anonymization, and it's relevant. That's how I would put it.
What you're describing is, so let's see how you do it without crypto. You'd basically make a pseudonymous email address. You'd put in, if you were to, if you wanted to support your favorite creator, you'd create a pseudonymous address. You'd subscribe to their Substack, pay $10, or whatever the subscription fee is, and then, or that puts that makes an entry into their database of who are the paying customers. And in the future, if you wanted to get a brand deal and the brand was willing to pay you an equity, you'd say, hey, airdrop this equity to the all of these people. At that point it breaks, because you can't,
Actually,
like, that is that is
it breaks even before, because the brand would have to interact with me and I would have to make a conscious decision of giving these 100 emails that can then be abused by the brand that I give it
mm,
to. The point is, in Web3, this query can be done without my permission, right? Like to just go check who has Joel's article NFTs is like 5 minutes, and you can see how long they've held it. You can actually do a lot of customization at that point.
I guess the analog is, in a Web 2 world, you would have a customer database that you own as the company.
Hmm.
Whereas in crypto and or in Web 3, there's no centralized database. So you have to make an entry in a decentralized database, which we call wallets. And what you're really doing when you transfer an NFT to a user's wallet for supporting you or for being a power reader or things like this is making an entry on a decentralized database.
Yep. Now tomorrow, if someone that holds a bunch of my NFTs want to say, "Hey, Joel is saying something really stupid. Let me find all the other readers that have been reading his stuff." They can actually make their own community. So it's not one to many; it's many to many, right? Or and that's really cool, because that's how I also think about content. And so you basically have network effects of these micro communities that are user owned. Obviously, these micro communities exist on Facebook. I'm not saying it's brand new tech, right? What's a Facebook group? What's a WhatsApp chat? But right now it's user owned, and it can be used to unlock all kinds of new use cases. That's how I think about it.
So, Joel, you work at LedgerPrime, which is a market maker first. Is that fair? A hedge fund second, and and a venture fund third. Is
Yeah,
that
yeah.
is that reasonable? Okay, all right. No, my first question is, how do you avoid kind of like the conflict of interest between those three entities, and how do you think about that? And two, a lot of these projects are going to be raising venture capital in the coming months and years, and they're going to then go on to negotiate agreements with market makers. Um, and that's a completely new thing to them. Folks do VWAP or TWAP agreements as opposed to loan option agreements. And what are the three or four most important things you can tell founders who are negotiating agreements with market makers?
There's two questions, right? So I'll just go for the first one, right? How do we avoid conflicts of interest between the three? I think just yesterday, a fund manager was telling me that hedge funds don't make good venture funds, and that's very true. It depends on what you're investing in, right? Like we're not investing in deep tech or bio research and the like. We're investing in financial infrastructure that's relevant for us as a market maker and hedge fund. So you take our portfolio, we have about 75 investments now. We have what is likely the world's largest DeFi venture book, where we have about 47 DeFi native investments. We do that because both the hedge fund and the market maker is able to use these products, and we don't have a mandate of selling them anytime soon, right? Like that's how we do it. But what we avoid doing is we don't invest in, let's say, a gaming company that's based out of Vietnam. That's outside our mandate, because how is the venture fund and how is the hedge fund and the market maker going to use it? We don't invest in things that are savvy or trendy through the venture fund. The venture fund has a very specific mandate within which we have invested in, and that is financial applications. Like right from day one, that's been the one thing that we've always focused on: financial applications and infrastructure that helps you build it. But what it also does is, whenever we invest in a venture, we are able to bring in the the market maker arm to help bootstrap a new market, right? How do you define liquidity on a DeFi venture? How do you provide capital for lending on it? Or how do you provide volume for those trading on it? Those kinds of things are actually taken care of by the market making division internally, and that helps teams bootstrap 0 to 1 very, very fast. But I think what's most important is you have that conversation with a founder, right? Like, you don't lie to a founder saying, hey, we're going to hold your coin to the end of days and then go ahead and dump it. Or if a founder pings and says, hey, we saw you move your coin, what's going on? We explain what's going on. So uh, I think that's what I like about crypto, is that it's so transparent. So I know what other VCs are doing. The founders know what we are doing. I know what the founders are doing, right? Like, we don't talk about what founder assets, or how do you choose a market maker, right? So there's really three kinds of market makers in the market based on my observation. One is the ones that charge a flat fee. That's like $10,000, $15,000 for a pair. Then their incentive really is nothing much, but that fee that you give them. The second is the option. Sorry, they also get a percentage of profit share. Now that is a very vague term because very different market makers have different ways of defining what is profit. The second is what is called an options agreement. They basically say you will give us a loan at current price. A year from now, we have the right to buy it from you. And the third is usually some market makers, like, we will likely be doing this with some of our portfolios. We just market make it for free because we already have exposure to the asset. We are market making on the product. We have enough ownership. No problem. We'll market make it for free. Ideally, you have a player that is, if it is an entity like ours, you have a player that has been with you right from seed stage, has meaningful ownership to go ahead and say, hey, we'll market make it for free, right? So that meaningful ownership is what it really boils down to. But if you don't, then what are the things you do? I think the options agreement model is good if you don't want to burn much. But I've seen cases where market makers are taking 2 to 3% of a token for market making as an options agreement. I think that's ridiculous. Anything north of 1% is also ridiculous. I would say if you are, if your product market fit is there, roughly about 0.5% is more or less 0.5 to 1 is a healthy benchmark, right? Because if it comes too low, what happens is the market maker has no incentive to really be involved either, right? So that's still a large chunk, but that's a possible number that people go with. Look, I think this just so that there's clarity on that 0.5 to 0.1%, right? If you are valued at north of a few hundred million, that conversation is not one to be had. You can negotiate it to be much lower. If you have enough liquidity on the assets, you can negotiate it to be much lower. Uh, the whole point is that you want to give people enough incentives to be involved with you. That's it. Some market makers would be like, yo, 0.1% is enough for us. Some would be like, hey, maybe 2% is what's. But the reason why I said don't give them more than one is because then how are you going to decentralize your product, right? Like, there are certain accelerators that take 5-6% of a network, and I'm like, that's not decentralized. That's I don't know what that is, but I don't want to be involved with it. Right? That's how I would put it. So no market maker should have a large supply because they could also be contentious and be toxic for the asset in that they suppress the prices at some point.
On that note, thank you so much, Joel, for taking your time joining us. We hope the weather in Dubai continues to keep getting better. Something that you won't miss Kerala after that.
Yeah, I mean, you get better Keralite food in Dubai than you do in Kerala. So the next time you guys are here, we'll go grab something to eat.
Thank you so much for joining us, Joel.
Thank you.
We'll chat soon, maybe before the next bear market.
Surely. Take care, guys. Thank you.